Hey guys, my name is Ben and I want to give you a quick story of how I came around to invest. So about 5 to 6 years ago, I was still in college. I was doing civil engineering and I went into structural engineering, and out of college I pretty much landed a job and that's it, right? All it did for me is to pretty much just land me a job. But I quickly learned that having papers or, basically saying, hey, I went to school to study doesn't really do much for you, right? I live here in Canada, Manitoba, and things here are more about what you can do, not what you can do on paper, right? Like you got to really have the evidence and the experience to go with it. So right away, they basically put me into a small drafting office where I pretty much could just start drafting, right? And I started with about, I don't know, at the time it was like $17, right? And it was nothing worth screaming about. It was barely enough to cover rent and stuff. So at that time, I actually got married. We ended up buying a small property outside of town, pretty much in a place where nobody wants to live, right? So we got a steal on the lot, and then I decided that I want to build a house on it, and pretty much I built it with my bare hands, right? I had some tools and I had some previous work experience around building home building, because I did it with my dad and my father-in-law as well. From the culture I'm from, a lot of people build their own homes, so I got that going for me, and that was obviously what you will see was huge to my early success and getting capital to investing. So I built my home. Within like about I think 2 years is how long we stayed in it. We decided to sell it. Um, we found another lot, uh, just bare land to build on, in the town that I'm living in right now here, which is a different town than where I built. And we struck a deal with a developer, and that's how we got the duplex lot. But I realized that I was actually not able to afford to live in a house, a cheap house for one, and build a duplex. And no matter how I twisted and turned, I realized that any interest rates would become problematic for me if the interest rates were going the other way. I was actually kind of fortunate when we initially built our house. Talking to the guy at the banks, yeah, there was a good rate at that point, and I just picked a rate, a term, and we said, okay, let's do 2 years, let's lock it in for 2 years, and we went with it, and turned out to be like that was the perfect pick because the rates were rising at that point, and they actually rose about 4%, but I think to about like 4.5, 4 and 3/4 is what it was then. So by the time the rates came down again, I was pretty much where I locked it in at 3.2. So, but my cash flow at that point was so tight, and I had no idea why rates were going up, why rates were going down. I didn't understand it. I had a very dark view on life and on the financial system. So, to me, it was a black box, and everything that came out of it was a surprise for me. So I actually just got lucky in the beginning, I believe. So I realized that I was pretty much house poor at that point. My job was not the greatest. And then shortly after I finished the build, I already had moved to a different company. I was earning a little bit better, but it wasn't much. I think it was just a couple dollars. And there I only stayed for about a year. I was doing purchasing and from and customer service from that side. Then I moved on to a different job, and there I was the sole drafter, basically the product designer, and everything had to come on my end. I would just submit the documents to an engineer later on. He would stamp it, return it, and then we could build it. We did a bunch of medical equipment for the government and in the mining industry. Yeah. So that was a really fun job, and that started to build my confidence around investing into myself, right? Into investing into my own knowledge, not from something that somebody is teaching me, but actually going out there and looking up things up for myself. Um, a short while later, that company was actually struggling a little bit. We had to lay off a lot of people. My job was secure, but the climate in that company was very. There was a lot of fighting going on in the leadership there, and yeah, I wasn't looking forward to work at that point anymore. They made me pretty much the production manager, looking after the product while it was being built, plus drafting it all up. Dealing with the customers, with the vendors, because nobody knew what was going on, and I was just burned out. So what I decided to do is I was gonna switch it up a little bit, and people heard about it, and that I was interested in taking on a new job. And yeah, sure enough, shortly after, a short while later, a company reached out to me in the agriculture industry that was looking for somebody that could pretty much do the same thing, right? Product design, pretty much everything that a draftsperson and an engineer can do. So after some negotiation, I started with them. So my whole life I've been a numbers guy. I look at the world through numbers, not by what people say, because as the product designer, you have to come up with results, right? You have to listen to the customer, you have to listen to the manufacturers, and you have to find how can we satisfy the customer, and how can we also produce it in a way that is cost effective, that it's easy to produce, that we have the capabilities even to produce it, to basically to manufacture it, right? And a lot of research. If I would ask for the research, basically it would never get done. So I pretty much had to do everything myself, right? Which can be very daunting, pretty much trusting your own judgments. But that's just what you have to do, and that is a very valuable skill I learned pretty much right out of college, right? So because I'm such a numbers guy, I realized that my finances weren't doing great, right? I was looking at my finances. We were able to save about $50 a month, which we just thought about, like, is that even worth investing, or should we just give it to other people that are struggling, or even struggling more than like we do? And but the wish in my heart was always to learn, to invest, to start to understand the economy and everything. So I started following a lot of channels online on YouTube. I started reading books. Went through a lot of audiobooks on investing, on the economy and stuff like that, right? So obviously, where everybody starts is usually Robert Kiyosaki, right? And I came across his theories very early on too. So because I pretty much come from the real estate side, um, what I ended up doing is, like, I thought, you know what, I could sell my house, I could build a duplex, live on one side, rent out the other, and and because COVID came around, and the interest rates actually really dropped at that point. I was on variable, and the interest rates dropped pretty much in Canada, like, to pretty much zero, right? But the mortgages obviously weren't quite at zero, but they were, like, you could get something at 1.9% for 5 years. You could lock that in, um, and I had no idea why that was so, right? I couldn't have seen it coming, so I saw it was sticking around there. The variable was like at 1.6 or something like that, and I didn't understand it. No, obviously I liked it, right? Because life was easy then. And I saw that because I started to follow the assets, right? Like Bitcoin, like the S&P 500, Nasdaq 100, the indices, Tesla. Um, yeah, like I had a huge watch list built by that point, stocks and indices and commodities. And also I realized that real estate was pretty much shooting through the roof, right? Things were getting expensive all around me. And then I saw homes being sold, like, for much more than I thought. I was starting to play with the thought of pretty much selling my house, which then, through some conversations with my wife, we actually decided to do that. After selling the house, we would move closer to work, which I believe was a very good decision we made. And pretty much I cycle to work, right? Just hop on my bicycle. In winter I can walk. So, but now that I did sell my house at quite a large profit, but now I had pretty much fear of what to do with that money because I hadn't started investing yet. I didn't actually, uh, tip my toes into anything yet besides real estate, right? I am still very confident in real estate. I understand it. I know what I'm doing. I can build houses myself, no problem. I can build a duplex, right? I can do the concrete, I can do the framing, I can do the finishing. Is all no problem to me because I come from a background like that where we do this kind of stuff. But I always wanted to get started on stocks. But the more research I did, the more I realized people just don't know what they're talking about. Like in one moment I would find somebody that I had like I would build great trust on, but because I'm always looking at all sides, and I'm always basically looking for the devil's advocate, right? Like, okay, what's the other side of the story, right? So I was looking for safety first because I realized how volatile it was. Like I couldn't afford to, make a lot of money on my house, then sell the house, and then within a year lose 40% of it. I would not be able to bear that, right? So for me, I only needed something that would go up and up and up and up. So the first thing I started doing is pretty much put it in a high yield savings account, right? So I opened up a TFSA, I opened up an RSP, I funded my TFSA, and I just put it basically into a money market fund, right? Very short term. I think the taker was a PSA. It's pretty much a savings account, right? And it was paying about 5.25% at that time. I was very happy with it because it was a decent amount of money at the end of the month that I would get paid out. But yeah, I had a lot of fear investing at that point. So I came around, dividend investing, value investing, looking at all the grades. But I did realize that no matter what they tried, and it seemed more safe, I always knew that the S&P 500 was just doing better than that. But I couldn't figure out why people just don't want to invest into the S&P 500 or into the Nasdaq or in the Dow Jones. But people were stock picking all day long, right? Because I don't know, they fell in love with the idea. So I started following YouTubers about dividend investing. I looked at, I'm not sure, I must have followed about 20, maybe even 30 YouTubers about dividend investing, and just from the analysis they did, I realized they really had no clue what they're talking about, right? So they would be pretty much yield chasing the whole time, right? Falling in love with the yield and buying companies that are pretty much going under slowly, and they're just all they're doing is they're paying a dividend. They're barely growing, and they basically have no innovation, and they're just paying out some cash. And when you look at the total return would underperform the stock market by a great margin. Like the stock market would do, let's say, 20%, and they would do 5%, right? And then it would pay a dividend, let's say, of 6-7%, and there you go, right? So it's 10 to 11%, while the stock market did about twice that. So I wasn't very happy with it. And then when I checked the price chart, right, they would drop in recessions, just like the S&P would, or like the Dow Jones would. I was a little bit confused by that, but obviously also not really, because they say, oh yeah, if it drops, just buy more, right? But some of these companies would never recover their all-time highs again. I calculated pretty much my whatever I had in money, and it was like, okay, if I go fully in on dividends, how many dividends will that what will that pay me out? For how long do I have to do this for the compounding dividend to pretty much take effect, so that I can retire with my current cash flow at that point? And that was a very long time horizon, right? I was still living very tight. I could only invest a couple $100 at that point. Things were tough. were very tough, and I felt a little helpless. So I found a guy who was pretty much then income investing, right? And you guys probably all know him, but I'm not going to mention his name. And basically, they built this whole fire community, and I was not very much convinced by what they were doing because I was realizing that the whole covered calls, and they basically were doing covered calls into dividend companies, right? And pretty much to even jack up the yield even higher. But even that, the covered call pretty much always underperforms the S&P 500 in the long run, right? It's just a short-term cash flow that you would get from it, and they just want their guaranteed cash flow. They don't care if the price goes down. That's what they say, right? But I actually have trouble believing that, because total returns is what I figured out very much early on is what actually matters the most, right? Now you can't just ignore it the whole time. In your head, it will always be there that your total returns are actually not matching, right? So I was following, pretty much at that point, I was following the dividend investors and the income investors and the value investors, right? And none of them were beating the market. And I know Warren Buffett has this track record of beating the market so many years in a row, but when I actually look at his portfolio right now, he hasn't. And he hasn't for a while, right? So he's pretty much just kept up with the market, but he's carrying a lot more risk in his portfolio, right? Don't want to take any shots at him, but I believe his portfolio is actually kind of bad, right? And we recently found out that he was sold half of his Apple shares, right? Apple was pretty much carrying his whole portfolio. If you take Apple out of his portfolio, the rest of the portfolio did about 6%. So he had a lucky shot and he stuck with it, and that was his saving grace. So pretty much his returns were Apple. So would I invest in Berkshire over S&P 500? Oh no, for sure not. If you take Apple out of the S&P 500, the S&P 500, if it did 10%, it wouldn't go down to 6. It would not even go down to 9. It would still be like by 9.6 something. Apple is not that big of a share of the whole S&P 500, and therefore, even if you take it out, there's other great companies in there that would be being allocated those resources. But for Warren Buffett's portfolio, it made a huge chunk of his return. It's estimated to be about 40% of his returns came from Apple. Sorry. About 40% of his returns came from Apple. And I felt like that was just not it, right? I do not understand why he owns Apple over Microsoft, over Google. I don't understand it. And yeah, so he pretty much just became a bad version of the index at one point. So then I go to the growth investors, and the growth investors are pretty much, they have a huge risk tolerance, right? They were trying to pick stocks that would go like 10x, 100x, trying to do that. They would write these calls on pretty much, and these people start becoming pretty much gamblers, right? It felt like Vegas, right? And every play they did, they were trying to make $1,000 into $1,000,000. That's how it felt to me. That was the attitude. So I learned their ways too, but I actually didn't do it because again I realized that during certain times these guys would massively outperform the market, but then it would get caught off guard and they would fall back by a lot. So that was a very interesting phase, right? And there was a lot of people in there that would only hold a few stocks, right? Some people are like, even like Bitcoin, right? I would say Bitcoin people are the same as people are like Max, or you know what, I only hold Tesla, or you know what, Nvidia only, or you know, all these guys. Or if you just have a few short plays, but you pretty much, these people would become like traders, right? Because they're looking for growth and they want to jump in and out at the right time, market timing, which also doesn't work. So I pretty much began the journey of figuring out how the S&P 500 is actually, why the S&P 500 is actually beating all these investors over the long run. And I found out that the magic was, or the strategy of the S&P 500 is superior to all strategies, and that's why. The S&P 500 doesn't discriminate between a dividend paying company versus a growth company versus a company that's doing share buybacks versus pretty much a startup like Tesla that wasn't profitable even, but already was in the S&P 500 because people believed and in the idea, and the value was in the idea, which dividend investors, value investors, they can't understand this, right? So the S&P 500 though is pretty much always putting money with winners and cutting the losers, right? At all time. I'm talking about the S&P 500 market cap weighted, right? S&P 500 market cap weighted index. And the market cap weighted index is where the strategy outshines. If you take the same S&P 500 and you do equal weighted, you don't get the same results, and it shows underperforming results. People say, or many investors argue, that we are in the S&P 500 allocates too much towards the large cap. But history shows that this is the way to go, right? Like the evidence shows that that is the most effective strategy. And that argument, I've heard that argument quite often, that especially they're saying is too much, right? You can't allocate so much towards Apple, Microsoft. It's out of balance. But when you think about it, again, like I said, I really like to do my own research and my own thinking of it, because that's what my profession pretty much requires all the time. So I'm thinking about it. Like I'm trying to make my own opinion here, and I realized that equal weighted is actually the one that is out of balance, because if you have a bigger company, more of your money should stick with a bigger company, right? And if there's a smaller company, less of your money should stick with it, right? Because a big company is big for a reason, and a small company is small for a reason. A smaller company might not have the ability to handle that kind of money, while the bigger company has the ability to handle a lot more money, right? So you will not, like, if there's a little business that's worth, like, let's say $1 million, and you throw 10 million at the business, they will misallocate that money, and that investment will not work well for you, right? You have to invest it proportionally to the size of it. Yeah. So the thing is that why value investors don't beat the S&P 500 or growth investors is we are not like, when you do that, you are not consistent with your strategy, for one. Your emotions get in the way, and you're not reevaluating your whole portfolio consistently. The S&P 500 doesn't care. It's results driven all the time, right? If a stock falls in their value, in their valuation, they pretty much fall with they fall down the ranks, and every dollar that gets invested into the S&P 500, they will get a lesser share of it, right? While the winning ones, the growing ones, the effective companies get more of it, and the investors that don't do it on a quarterly basis and are not able to take their emotions out of it completely and just stick to the strategy will always underperform it. The evidence is in the pudding, right? So that's why, even if most of the companies, let's say even if they just stay flat, and one of the companies is growing and growing, more and more money gets sucked into that company, which is only fair because that company is the one that is growing, and a growing company will likely keep on growing, and a company that is stale will likely stay stale, right? And a declining company will likely decline more. A trend is a trend for a reason, right? Yes, there's like one-offs, because, like, let's say in a tough year, but then usually many companies in the same index, they all fall together, so the allocation stays the same relatively to each other, right? And the market can recover, and sometimes one sector goes up, the other one goes down, but because we're reevaluating, or the S&P is doing it on its own, pretty much, right? every quarter, you are basically put on a trend. Let's say if that trend lasts for about 3 years, you are basically allocating towards that trend. The trend then shifts, and you're reallocating towards that trend too. As an active investor, you have to pretty much predict these trends, and if you didn't predict them, you have to be willing to say, okay, I was wrong, we're moving this way. Okay, I was wrong, we're moving that way, right? You have to become a robot, and that's why the algorithm pretty much of the S&P 500, it's not quite an algorithm, but it's pretty much an algorithm, um, was pretty much proven to be the best way there is so far, right? Now, will there be another index at one point that has a slightly modified version of the S&P 500 and beats it? Yeah, probably, maybe, right? For example, the Nasdaq 100 is already, doing that because it's cutting out insurance companies, financial companies, and it, it does better, right? And obviously, it's more volatile because it has a lot more tech in it, and it's only the top 100 companies, right? So a lot of the slow-growing companies are not in it. As long as somebody has the guts, right, and can stomach the ups and downs, that should be also a great place, to invest capital. I realized that the S&P 500 was pretty much unbeatable for most active funds and active managed funds, and even for most investors, because investors are very emotional. And even if you have 90% of the S&P 500 in your fund, but you carry 10% cash, you're already underperforming. If you are delaying your investment, let's say you're dollar cost averaging into the S&P 500, but you're delaying, you're probably underperforming right there, right? If you put bonds into it, you're underperforming. If you put real estate into it, let's say some REIT, you're underperforming. If you put gold into it, you're underperforming. I don't want to invest, uh, not wanting the volatility and giving up growth for downside protection, which is always short term, right? Gold will never go to zero. The S&P 500 will never go to zero, right? The Nasdaq will never go to zero. A single stock will, and all of them will eventually, but the S&P 500 will keep rising because of the structure of how the fund is built, right? So pretty much what I decided to do at that point is to see if there is a strategy that does something like the S&P 500 or the Nasdaq 100, and find similar funds that can do even better than that. And it was very hard. Like I looked at global funds and overseas funds, and for example, I live in Canada, and we have the TSX 60 here, right? That the TSX 60 is not doing too bad, but it is underperforming the US because of the technology that is in the US, and we're mostly services here, right? So in utility services, we're like very basic. But any crash, right? Like it wouldn't tell. You wouldn't say that the Canada is safer because a crash in the U.S. was a crash in Canada. We're so joined at the hip, and I also saw the same thing happen to everything that is international, right? So now if you check out, like if you would look at the indices from all over the world, they were pretty much moving together with the S&P 500. But when it came to the upside, the S&P 500 is pretty much killing it, right? I don't see that changing anytime soon. With the whole de-dollarization theory and the BRICS and everything when it comes to the currency, and even if the US dollar collapses, equities will still shoot through the roof, right? So there's even more reason to stay in equities. Not jump to a different currency, not jump to gold. Gold, in my opinion, will probably never be currency again. It will always be a reserve. And, I might be wrong about it, but even if it becomes a currency, equities will outperform. The same thing with Bitcoin. Bitcoin makes sense that it outperformed in the beginning, but I think the adoption cycle is definitely slowing down, and we can see that the evidence is there. It's still adopting, but it's not at the same rate anymore, and underperforming the Nasdaq and the S&P 500. Any company that's doing cash flow, right, that is actually beating inflation will always beat Bitcoin, because Bitcoin is a non-producing asset. It's a commodity. So eventually it will pretty much become like a stable. It will become like gold, but probably slightly better, because the cash to flow ratio in Bitcoin is better than in gold. And gold is about we dig about 1.8% of additional gold out of the ground every year. That's what it averages out to, and because of that, supply inflation, um, it pulls a little bit on the price backward. Now, if that growth slows down dramatically, then obviously the demand will push the prices much higher, right? So that is the argument for Bitcoin, because eventually the growth, the flow from the supply side will get less and less, and the demand should stay the same, or even increase for that reason, right? Because the supply is so little, and that should keep the price rising and rising. But eventually, because it's a non-producing asset, and we're not actually, peeling back the amount of Bitcoins, like even reversing the amount, like for example, profitable companies, when they do share buybacks, they're actually reducing the amount of shares, and basically there's a crowding out, right? So that's why that shoots the asset through the roof, and it becomes very speculative environment. And if you can hold on to some shares, let's say for 10 years, then just over that time horizon, of all the shares that exist, your piece of the company could have been grown by 30% already, if they do 3% share buybacks per year. On Bitcoin, you won't just increase your total holdings just by holding it, right? Okay, some Bitcoins get lost, but it won't be 30% over 10 years, I can tell you that. Yeah. So, and the other thing is, obviously, something that is productive is always more valuable than something that is non-productive. There is a place for gold in the world. There's a place for Bitcoin in the world. But for the other precious metals, I believe they are just a raw material at that point, right? They will become whatever everything else has become in the past. There were many things used as money at one point, like seashells, even like little granite pebbles, and all kinds of stuff. Like a lot of things were money at one point, and copper and stuff, right? But it was just barter, pretty much, right? The better form of barter. So, and then as soon as better money was found, something that flows better, that you can, that was easier to transport, stuff that can't be stolen, all this, there's more security and stuff like that. It pretty much, these things didn't stop being money at that point, right? And I believe silver falls into that category, that it's pretty much just a material. No, it's a precious metal, right? But it's not a precious currency, right? People can say that because, like, okay, silver is money, yeah, so is platinum, right? So is uranium, right? It's a commodity. Leave it at that, right? And same thing is for gold. It's a commodity that holds its value very well, and because the system is already kind of built with gold, and the central banks love gold, they all have agreed that gold is a certain value, because digging it out of the ground is actually kind of tough. Unfortunately, with silver comes out of the ground about 15 times more than gold. And when the price shoots up, rises, the incentive to dig out silver becomes much greater, and the supply will be increased very fast, very drastically. And that's why when you check the price of silver, it is very spiky, right? Which a lot of miners are also shorting the price, because they know the price can't stay up there. So don't believe anybody that says, yeah, it's the Wall Streets that are dumping on your head with shorts and stuff like that. No, my friend, these are the miners that are producing the silver, and all they're doing is they're locking in a price at which they then can pretty much sell their silver at. And it works like this: if the price is, let's say, $50 for silver, and I'm a miner and I short it, then if the price goes down, I'm making money on my short, But when I sell the silver that I produced, I'm not making as much money. So I pretty much locked in the $50 for all the silver that I'm producing. So I will adjust the size of my short to the size of my silver, right? Like how much I'm producing. If my short goes the other way and let's say it spikes to $75, I will just say, well, I can sell my silver at 75, which is great, but my short kind of went against me. I just locked in the $50 and that's it, right? Yeah. Well, that's it. You know, I'm trying to make it fairly easy for everybody to understand. So forget all the manipulation. It's not how it is, right? They want to try like they just pump silver. That's all they do. They're just pumping it. And at one point, like I bought silver, right? I still have some silver, but it's not what it's cracked up to be. And I would encourage you to look and study other investments, especially the S&P 500, because there are some things that we can do there that will help us greatly. Much better than silver. Silver pretty much just stick to inflation. When you're buying at a peak, I feel very sorry for you, because the recovery can take many years, can take decades, and we might never get there in our lifetime again. Because the technology to dig out more silver is getting better and better, and at some point we will just have robots looking for these things, and so it will not hold inflation, right? It will not. Even if the demand increases, we don't even know how much silver is in the ground, right? We keep on finding more and more. Just look at all these miners, finding more and more places to dig up silver from and how much they're advertising. Oh, there's so much, but they're not producing it yet because the price isn't there yet. But when the price goes to that spot, like they will dig out of the ground all kinds of silver, and silver is mostly a byproduct actually right now in the copper industry and in many other industries. Like I'm going on a rant right now, but I hope you understand what I'm saying. Is when the price goes up, they will find more silver. They will look for it. They know where it is. They will get it out and they will sell it to you. And at one point, you have emptied your pockets. You've bought all the silver, and they will keep on dumping more silver onto the market, and the silver price will drop back down to its normal levels, where it's more or less in line with production again, where supply meets demand, right? And there you go, the whole population now has a bunch of silver, which they hold on for years, right? So I'm not saying it's a terrible investment. I'm just saying it's not it's not what it's advertised to be. It should be used as a metal. It shouldn't be in your vault or anything like that. It should be in the solar panels. It should be in the microwaves. It should be in the appliances, where it belongs, right? Like it should be put to use, right? If you're using it for medicine or like medical purposes, if do that, But yeah, as a purifier or whatever. So precious metals is one thing, but precious metals is usually just for the banks. Let the banks do that. You can build on the next layer, which is way more beneficial to you. Look into businesses. Businesses at the end of the day make the world what the world is. It isn't gold. It isn't silver. It isn't Bitcoin, right? Even though these things are important, what builds wealth for me and you is business, right? Business, right? Stocks, right? Shares, equities, whatever you want to name them. Now these businesses, for one, they have to beat inflation. They have to beat the compound annual growth rate of gold, right? If it can't even beat a non-productive asset like gold, then why do you hold it, right? It makes no sense, right? And that's why I have a lot of issues with international markets, like with the global markets, is many of them can't even beat gold, right? So I don't want to hold it. Anyways, long story short, the S&P 500 and the Nasdaq100 have been pretty much kicking ass, right? Since inception, and I don't see it ending anywhere soon. The strategy is what makes it so great. The market cap weighted index is where it's at. The Dow Jones has a different system, and it's not a great system. And how I know it's not a great system is because if you just have to look at the performance. It invests into the similar stocks as S&P 500 and Nasdaq, but Just the strategy changes, and the strategy then has different performances, right? So if you have a better strategy and your chart goes up and up and up and up and up, doesn't mean the economy goes up and up and up and up, right? The S&P 500 can go up and up and up and up and actually beat a lot of the, and anybody that's invested in there is making a fortune, but the economy underneath is deteriorating, and the people that don't have assets, these stocks, right? They might be underperforming big time. Same with the equal weighted indexes. Let's say they might even be flat, but the market cap weighted could be up 5, 6%, 10% for that year. It's because the strategy is different. There's this. I've come across a few very seasoned investors already saying that, the S&P 500 is just the average. It's not just the average, guys. It is not just the average, because they obviously don't understand how the S&P 500 works. Again, they haven't ever looked into it themselves. Do they even know what they're talking about? Because they're saying, the average investor, is making 10%. No, it's not true. It's not true. Because they say the market is the S&P 500. The S&P 500 is not the market. When you say the market, what they think they mean, or what they say is, it's the whole market. But it's not the whole market. There's way more to invest in than just the S&P 500, right? For example, is there just 500 companies in the US? No, there isn't. There's way more than that, right? For one, about 19% of the market is private, right? The other thing is, there's over 3,000 companies in the US that you can invest in, not just 500, right? The other thing is, there's something called the bond market, which is bigger than the equity market. There's real estate. There are commodities. And real estate is huge. Huge. Commodities, it's not a small industry. If you take the whole market, yeah, okay, maybe 50, then it's 50-50. But what does the whole market look like, right? So you have to basically say every investor that just invests in the in the S&P 500 is doing 50-50. But the thing is, none of them are only in the S&P 500, right? That's what I'm saying. If you take, for example, VT, which is Vanguard's total world index, right, which has about 10,000 stocks in it, it actually underperforms the S&P 500 by quite a large margin. So is that where the 50-50 is at? I would say no, it isn't, because even there, people don't just hold the VT. They have bonds again. They have real estate. They even throw in oil in there. They put gold into their portfolio. They put all kinds of precious metals, all kinds of commodities. Like, who knows? Even coffee beans and orange juice in their portfolios. Who knows? Because they're trading, they're gambling around, and a lot of them hold cash because they believe something will go down, right? And so at the end of the day, turns out that about only 1% of investors match or beat the S&P 500 consistently. And the only ones that beat them are the ones that hold the S&P 500 and some Nasdaq, or are all Nasdaq. Now, obviously, on any given year, you might underperform the Nasdaq the S&P 500 if you hold the Nasdaq. But over the long run, the world keeps on innovating, and all the growth will come from growth companies. So that is why it will always outperform, right? Now, they say that you can't outperform, and basically looking for alpha and everything, and but I had to start smiling a little bit when about that fact, because that's not all there is to investing. And there's actually a lot of things you can do to outperform the market, but the people that figure it out, and trust me, it's not by stock picking, right? People that stock pick underperform for a little bit. They maybe even have a hot streak, maybe even 10 years, right? But then they underperform, and eventually the market has caught up to them. And it's a tough life that way anyways. There's an easy way. There's actually an easy way to match the market and to outperform the market. but it's not the way. People don't talk about it, right? Because you're being sent off in the wrong direction. You're being sent that way, and really you should have been looking this way, right? And that's how I invest, right? So I've been outperforming. It's actually fairly simple. There's not much to it. Um, you know, it's nothing fancy, right? I don't give away that information for free. If you're interested in that, then hit the link in the description, and it'll take you to a pretty much just a course. But you can finish the course in one evening, and you know what? My secret is yours, right? Do with it what you want. Teach it to your friends, teach it to your family, and I hope it blesses you. You know, the same way it has blessed me. But on this channel, I am only going to get you to matching the market and outperform the market pretty much by just using the Nasdaq 100. Get you comfortable with the volatility of it, because the way I invest also has volatility in it. Pretty much the same as the Nasdaq and the S&P 500. So, I'm not using margin. I'm not taking a loan to invest, right? Um, there's no fancy option strategy or anything, like nothing like that. Yeah, it's just as basic as if you're somebody that can buy an index, you can do my strategy, right? Because most of my strategy is the index. Okay, the S&P 500 to be exact. Yeah, I already told you like 3/4 of what I do, but you will never guess the rest. Because what I do there is actually it's backed by university research, and what I find funny is that they came just short of the solution, and they stopped with their studies there, and they turned around and basically said, wrote a report on it, on their study, and that was it, and yeah. Guys, actually a very interesting topic is life cycle investing. If you guys want to know what that is, it's a study also done by the universities, right? And they found there's actually by two professors, and they found that basically, because I've come from a real estate background, in real estate it's very common to take out a mortgage, right? To go get into real estate. People feel very comfortable with it, but you have to realize that the foundation of society is businesses and not real estate, right? Businesses. Everything is a business, right? And so people feel very comfortable with taking out a mortgage, and the mortgage can be as high as like 5 to 1, even higher than that. Here in Canada, it's very common that people have to do a 20% down payment on their first home, right? If it's a rental investment, let's say it's about 25%. But obviously, there's ways you can do it where you can have even less of a down payment, and get into housing that way. So nobody shuns it, right? So life cycle investing actually looks into taking on pretty much an investment loan, which just is similar to a mortgage. Sorry, similar like a mortgage. And basically you would take that investment loan, fund your RSP, fund your TFSA. For you guys in America, that would be your Roth, right? Roth and 401k. And you pretty much keep on doing that. You can also use a cash account, margin account, RESPs, FHSAs, right, for Canadians also. And, start putting money towards that right away off the beginning. And then pretty much have your loan and then pay that loan back over time. And they show that is actually a strategy that is very, very, very effective, right, for wealth building. And that's how you can actually outperform the real estate market, not in terms of like return, but because you're working with way more capital right off the hop, and the growth pretty much accelerates. You're basically doing arbitrage, right? Because you are only, let's say, paying for the interest loan, let's say 4.5% or 5%, but then the market on average gives you 10%, right? So you're pretty much bagging that 5% right away, and over time, usually your income goes up, and you can not just pay off your loan slowly but surely, but you can actually add contributions to it, or even get a bigger loan if you wanted to do that. And now people are obviously going to go all crazy and say, what kind of stories are these? This is absolutely nuts. But I tell you, that is actually not nuts. What is nuts is taking a car loan. What is nuts is using a credit card to go on vacations. What is nuts is being house poor. What is nuts is not being able, when it comes to how money is supposed to be used, people have their hands up in the air, right? But when it comes to some vacation, a boat, a camper, something like that, right? And people take out a line of credit or something like that, then everybody's like, yeah, I would have done the same thing. Like, have we gone completely mad, right? What is that? So in real estate, it's the same thing. Okay, but some people run around buying houses cash, right? But I would never do that. Buying a house cash there's little reason except for fear why you would do that. If the interest rate is below the rate of inflation, right, then take out a mortgage, right? The money comes from money heaven anyways. The money doesn't actually exist, you know. And I can get into that topic a little bit later. Basically, where money comes from and who is actually borrowing, lending you that money that you borrowed. Yeah. So pretty much real estate is a game where a lot of leverage is in. Yeah. And the same thing you can do in stocks, right? But you should look into that topic on your own and make your own assessments there, talk to your advisors. But I believe that if you have the means of securing a loan that is about half the growth rate of the S&P 500, and don't max yourself, up to your eyeballs in debt. That's not what I'm saying. I'm saying, but you can boost your contribution today, and pay off that loan, and even roll that loan over when it comes to maturity. There's different types of loans. You just have to ask, and it's not financial advice, but look into it, right? It's just education here. Okay, so. And then, people say that they like real estate more because it's something you can touch, feel, and see. A business you can touch, feel, and see too, right? And actually you benefit from it as well. So it's the same thing. If businesses, like if the S&P 500 is struggling, your housing market is struggling, your house is struggling too, right? So I would rather have not my eggs in one basket, which means just my house. I would have, rather have a little bit of a split going on here, especially if you have a TFSA for Canadians, or I believe it's a Roth in the US, or whichever account you can actually draw out of if you wanted to, like right away. Pretty much using it as a savings account, right? The reason is because let's say you specifically struggle a little bit because you lost your job, not because the economy is doing particularly bad, or even if it is, you can still sell some of your stuff at a discount, right? Like, okay, the stock market is down by 20%, but you got to make payments today. Otherwise, you're on the street, right? You're getting kicked out, all kinds of problems. So if you have a split portfolio like that, you actually have funds on the side that you can access, right? Even if you're actually taking a hit there too, but at least it doesn't get you, that you still have enough money for food and whatnot. It's an emergency, right? And emergencies can be a lot bigger than just 2 to 3 months of savings. So that's why I really advocate for, it's good to own real estate, it's good to own a house, but it is definitely good to have investments on the side that can be liquidated very fast and turned into cash to live off of in case of anything. Yeah. So life cycle investing could be the same thing as a mortgage. Let's say you're a very young person, you're just starting off. Very often getting into the real estate, there's quite a barrier to entry, right? Like you need to have some capital, and that capital can be built right away in equities, in the investing world, right? So open your brokerage account, do DIY investing, and look into how to do that. That should be your number one priorities pretty much as soon as you actually have any capital, right? Savings is the first thing you should do, not spending it. Here's a funny thing. Did you know that the top 1% in the US own 50% of the US equities? And the bottom 50% of investors in the US own only 1%. In Canada, the top 1% owns 25% of all of Canada. And the bottom 40% of investors own 1%. Let that sink in. About half of Canadians have an RSP, which they contribute to. In any year, about 50% of Canadians contribute some money to their RSP. Only 12% of Canadians actually maxed it out that year. I mean, just put in their maximum amount. And only about 9% of Canadians max out their TFSA contributions for that year. That leaves you with about 4% of Canadians that maxed out their RSP for that year and maxed out their TFSA for that year. That's about 4% of Canadians. If you're that kind of guy, welcome to the top 4%. If you're that kind of girl, welcome to the top 4%. It's not that hard if you put your mind to it. If you're still living at home with your parents, this is fairly simple. If you're working already, especially if you're just investing for yourself and you don't have a spouse. In my case, for example, we're a one-income household. I have my RSP, my wife's RSP. There's a little bit of history on that, right? So I can still max that out as well. Her TFSA and my TFSA. Right? So that's a lot more money. But for somebody that is still living at home with their parents, even a minimum job can do it. Minimum paying job. You just have to manage your money right. And there is enough yet for having a car. There's enough for having fun. There's enough for a lot of things in there. So why am I saying all this? It's not the amount of money that you have. It's what you do with the money that you do have. If you're treating it, if you're treating yourself, like if you're taking yourself serious, right, you can get where you want to go, right? And you can become the 1% today, right? Not by net worth, by habits. And these habits will compound on each other. You will get smarter, and your incentives, or basically your priorities in life, will build around investing first, which is called paying yourself first, right? You're investing into yourself first. You're buying your own assets first. And if you're doing that in a large enough ratio, maxing out your RSP, maxing out your TFSA, opening an RESP if you have it for children, right? FHSA if you are renting, even a cash account like a margin account, right? And start funding that. That is building your own business. You are building your own legacy. You're taking care of yourself. It's the sensible thing to do. You have already become the 1%. And I'm not talking in an evil way or anything, right? But you are doing what is in the best interest of yourself. And actually everybody should be doing this because this is the right way to do it, And if you don't do this, then unfortunately you will be slowly but surely be left behind. In Canada we have a great pension plan. I checked out the papers recently, how well the Canadian pension plan did. They did about 8% last year, which for all the pension plans in the world, that's actually spectacular, right? Canada has a very well-funded pension plan budget, and it's very well funded, and they doubled the amount of money in there. I compared it to European companies and countries, and from what I was seeing, we had about twice the amount of Germany, but we're half the people, so in Germany you're also very dependent on your own investments or something on the side. that will get you through when you become older. So Canada's actually doing a very good job, but I wouldn't rely on it. Things can change, and if it's that easy to invest, guys, just start doing it. Just start doing it. Learn about it. So actually, I want to tell you a short story. We have a guy at work, and I started talking to him about investing. And at first I don't believe he took me very serious. Like who are you? Like investing. Like what are you doing, right? But like through a few conversations, he started to get interested, and then every now and then I saw him, starting to check like stocks and indices and stuff like this. I actually gifted him a silver coin, so I actually do this with many people, like to it's bait. Yeah. Um, but it works, it gets the wheels spinning up there like really fast, and that guy was actually into like modifying cars and flipping cars and stuff like that, and then spending money on vacations and stuff like that. But I started talking to him about investing and all these things he do. I showed him the platform, that I use. I showed him this, then showed him this, and I think at some point in the beginning I thought like he probably just watches me do this, and he might not even be interested, but I will make him like kind of just always like 100 touches to that area, and eventually he will get comfortable without even, you know, just being around me. Guys, you won't believe what like he is different. He is different. He thinks differently. He talks differently. He's become a true disciple of the kingdoms, basically, right? He all of a sudden, he thinks way different. Instead of blowing his money, he's now paying off. Like I believe I'm not sure, but he was basically paying off. Let's say he was paying off his debt, right? He stopped blowing money just into the oblivion, right? All of a sudden he found money, and he got creative of, how he can still live a certain lifestyle, spending way less, right? And he's now investing heavily. And you know what? He found out, right? He found that his friends, were even interested in that. And so their behavior changed. So parents, if you have kids, teach them about investing, right? And don't just teach them, show them what you do. Like get going on this kind of stuff, do it yourself, and then show it to your children. And don't talk about the other things that they do and constantly, nag on it. Right? Oh, you shouldn't be wasting your money. Do that. He knows that. She knows that. What she doesn't is know what to do with the money. Right? That was always my issue. Everybody tells me, Ben, don't waste your money. Don't do this. Don't do that. Yeah, okay, nice, cool. What am I supposed to do then? What am I doing? Right? Show me how. Right? That's the issue. That is the issue. So the behavior will change itself once the person sees the truth about investing, right? So, and that's where we're at right now, right? That guy was a little bit of a lucky guy, so I actually taught him the way I invest for free. And he's teaching other people too, like for free, but he's being respectful about it, and for like only close friends, families, and stuff like that, because yeah. But the behavior changed, and he smartened up so fast. He grew up so fast. I believe he's 23 years old, and all the trying to talk sense into a person doesn't help. But as soon as you actually show the person what works, you can just walk away and say, what, there you go, I showed you the truth, and you see that it works, and you could do the math from here. I know you will figure it out. How and now he's thinking, okay, how can I fund more? How much do I put in per month? Okay, if I scale back a little bit here, no, okay, this vehicle would actually not make sense for me. I will actually take a different vehicle on. Okay, here, actually, let's do only one vacation a year. Let's actually do this vacation differently. Let's do this, let's do that. This is just as much fun. It's a little cheaper. Do this, do that. And all of a sudden you see that guy, I don't know how his work schedule was before, but people that start thinking that way, they show up to work. They work hard. They don't take days off just for fun, to blow it. because they value their money they're making right now. They know what this money is worth in the future. They know what $100 today is in 20 years, especially if you're making more than 10% a year on that money. If you're making 18, 19, 20%, 25% on that money, and you compound that over 20, 30 years, you'll be like, I'm not spending that $100. Are you crazy? That's the attitude that comes out of it. They say, okay, you know what? I have a budget, but that's it, right? I know I need to have fun, right? I know I need, I need to live a little bit. But you know what? Investing is fun too. It's actually very fun. And once you see stuff actually go towards in your favor, then things become very, very interesting in your life. And there's things that you start looking forward to, and you actually start to understand life a lot better. So take the time to learn. Take the time to learn about investing. DIY. Do it yourself. Become fully responsible for investing your own money. Right? Taking advice is fine from advisors or whatever. Make sure that you're not paying through the nose for these people, because at the end of the day, they can only tell you whatever is within their policy for the company, what they can talk about. Because everything else will get them fired. And there's a lot of regulations in that company. So like here on YouTube, we can pretty much say whatever we want because it's not financial advice, right? It's entertainment, it's education. I'm not telling you what to do, but I'm asking you, look into it, right? For your own good. Okay, let me get to the topic of where money comes from. Okay, so for one, we say money printing, right? It's actually not printed. It's actually loaned into existence. All the money that exists right now, we're not living in a cash society, we're living in a debt society. And that's pretty much everywhere across the world like this. Yeah? So it works like that. I go to the bank, right? And let's say the central bank put down a new interest rate, let's say 1%. Is the bank giving me 1%? No. Why? Well, they want to make money. Because when I go there and I borrow money, that money is either coming from somebody else, but if nobody is taking on, and the federal or the central bank decided to do QE, they pretty much open up a pocketbook and they say, you know what, anybody that wants money, lend to them. Here's infinite amount of money in my pocket, right? And so when I go and take a loan from a bank, they pretty much write a contract and the money gets created out of thin air, right? And then it gets turned around and that contract can get sold and people can buy it. I can turn around and buy the mortgage industry and pretty much hold my own mortgage indirectly, right? Like kind of like that. But that money pretty much came out of thin air, right? The money pool just inflated. It inflated. That's how the system is built. So I can through doing loans, businesses through doing loans can inflate the money supply. So the government, but has the same issue though. They also run like they have expenses galore, right? Like way too much, and they become insolvent all the time. But they push up their debt ceiling. They just keep on spending because they know exactly that there is a wallet out there pretty much that has infinite amounts of money potentially. There's a money supply. The money supply can increase into infinity. But it is the Federal Reserve or the central bank of that country that makes it possible. So stuff doesn't just get printed out of thin air, but money does. And it's not the government's fault only, but it's also you and I. And that's just the way it is. So we can point fingers to the left and to the right, right? But at the end of the day, it's our fear that pushes inflation. It is our decisions that make people greedy. It's, like we are the greed, we are the fear. The government is just the government. We are electing these people, right? Collectively. So If we want to see things change, we have to change. We just have to get better. So now you know where money comes from. Do you want to hold paper? No, obviously not, right? Like cash. And the money supply increases all the time. Well, there's cycles, right? They even do QT, which pretty much shrinks the balance sheet again. Basically, the pool of money can get shrink again, and you can also shrink the money supply by paying back your mortgage. Yeah, paying off your loans shrinks the money supply. Believe it or not. Yeah, when the government pays back their debts, which they don't really do, they just roll it over. It's just pretty much a credit card that gets a bigger balance on it all the time. But that's how the system was built to work, and that's how it will continue to work. Yeah. So, friends, it's been over an hour. I enjoyed talking to you. I hope you guys got something out of this. Stick around in the channel. Look through some other videos. I'm working on a series called Beat the Market. This might be part of the series, but there's more episodes coming. If you guys are interested in my course, check the link in the description. If you guys are serious and actually do want to outperform the market, and because you feel like you have a good grasp of volatility, and you feel like, okay, you can handle a little bit more volatility than the S&P 500 gives you, and if the S&P does like 23% drawdown, if you're okay at the same time having a 24, 25, 26, 30% drawdown, you can dial it up the way you want, but that bigger drawdown, right, also gives you a much greater return towards the upside. So if you're sick and tired of making just 10% and you want to earn 15, 19, 20%, check the link in the description, guys. I will see you in the course, and everyone else, have a great day, have a great night. I'll see you guys soon. Bye.